Hello, everybody. Welcome. We're going to wrap up Chapter 7 today, and I'm going to jump into the sheet where I left off. Today we have bonds and posting those transactions to the financial statements. Remember, because of the holiday, there's no class on Friday, so our next meeting after this one will be on Monday. All right, so I'm going to jump over to the in-class questions. I'm going to share my screen with you. Okay. All right, so we're talking about bonds. And bonds have a stated face value with an interest rate. And payment periods for that interest. Bonds are issued by companies through banks usually. And companies have bond rating agencies like Standard & Poor's. Moody's. I think Fitch is the third one. Rate their bonds, usually from junk to high quality. The ratings of the bonds suggest their risk to investors, or excuse me, to debt holders. Sorry, I'm gonna move a window here real quick. Based on the ratings, and the interest the bonds pay, that determines what the market will pay for the bonds. For example, if a bond has an A rating and is offering 8% interest, while most A rating bonds are offering 7% interest, the bond will sell at a premium. And vice versa. If the bond was offering 6% interest, it would sell at a discount. Our bonds that sell at par or face value sell at 100% of value. Bonds that sell at a discount are less than 100%. And at a premium more than 100%. Okay. Now, in order to track it, typically we create a bond table or amortization table. So accountants create a table. And so we have, for example, 7 through 11, company assigned a $10 million, 6% 10-year mortgage note to the financial institution. Now, bonds can have the option of being able to pay the principal at one time at a later date, or it can be paid in installments. And in this case, this is 10 equal annual installments. Now, you can usually find the payment yourself if you have a present value table and the interest rate information, but for this class, this is mostly a precursor to the accounting classes and finance classes that go on further, so you don't have to find that information. So what we're going to do to create that table is do something similar, and I'll bring it in from Excel. So give me 1 second. To a table like this. So here we have the mortgage balance, your payment number, how much the annual payment is, and a way that we can calculate the interest and the amount of the payment going to reducing your principal balance. And the way it works is that the mortgage balance is what somebody owes the company, and so they're entitled to interest on it. In this case, it's 6%. So they would have 6% of the $10 million. That must be a double, so. No, that's not working. All right, I'm gonna have to type it in. Give me 1 second here. So this would be $10 million multiplied by 0.06, and that would equal 600,000. So of that annual payment, the 1,358,679, 600,000 of it is going to be interest payment. The remaining 758,679 is going to be a reduction in the principal. So we have 1,358,679 minus the 600,000 that goes to interest equals the 758,679. Okay, I got a question. Yeah, I'm missing a 0 and 10 million. All right, thank you. Yeah, over here. All right. And so now, next year, after the first payment has been made, our new mortgage balance is going to be $9,241,321. Our payment's going to remain the same. And so we have to calculate our interest. And so we have the 9,241,321 multiplied by 0.06. And that's going to be equal to $554,479. And we take that 554,000 and we subtract it from the 1,358,678. And that equals, excuse me, yeah, I got a couple typos in there. I will correct those. $804,200. Sorry, that's $554. Here, this is $679. Sorry about the typos there. Okay. So now we take the 9,241,321 and we subtract the 804,200. And we end up with 8,437,121. Now I can use the Excel functionality and multiply that number. Then I can do some formulas. And then copy that down. Oh, that didn't work. And you'll notice here on the last payment, I added 7 to it. And that's what you would have to do to just sort of work out the rounding and the interest. So the way it works is that a little bit more of the payment each time reduces the principal until the last payment, the 10th payment in this case, which you adjust that amount and it covers your final payment. I'm going to put a page break in here. And then we can move down and answer these questions now. So it asks, how much of the first mortgage payment was interest? Round your answer to the nearest dollar. So we know from our first payment that it was $600,000. Okay. How much of the first mortgage payment will be used to reduce the principal? $758,679. All right. So now in the chat, to me, I want you to answer question 7-9. Over the 10-year period, as each installment payment is made, a portion of the payment that is interest expense will. Okay. All right, most of you got it, but a few people got it incorrect. So we're looking for our interest expense. And so that is the second to last column. And what's happening here, you'll see it goes from 600,000 to 554 to 506, all the way down to 76,000 in the final year. So the interest expense portion is decreasing. Over the 10-year period, the amount that's reducing the principal is actually increasing. Since less is going to interest, more is going to principal. And so we have less to pay off. And then the last question, over the 10-year period, as each installment payment is made, the company will show on its balance sheet for mortgage payable, and that tracks with the principal, and that will decrease. So that is from our table, this column in yellow. We can see that decreasing. All right, I'm going to try the poll. I had a little bit of trouble with the first class, but if you can see it, if you have a question, type yes. If you don't, click no. If you have a question, type it in the chat so I can follow up with you. Okay, I've got 2 yeses, so I'm gonna hold on a second here and wait for somebody to type it in the chat. Okay, so I have a couple questions. The first question says, is the table going to be in the document after the class? And the answer is yes. This table will be in the document, and like other Excel embedded objects, you just double click on it and it'll pop up for you. And what the second question asks about why it appears interest decreases and principal increases, and it's related to the payment. It's the amount of the payment. So the mortgage balance initially, your payment is going to be some to interest and some to principal. And as a result, that principal drops. And so the company's entitled to 6% of interest on what you owe them. And since you owe them less, that amount that's interest is going to drop. And if you're making the same payment schedule, more of that is going to go to the principal. And as a result, your balance is going to drop. So this is how it works when you buy a vehicle or when you buy a home. Initially, you're paying a lot of interest because most of your payment is going towards interest. But then over time, more and more of your payment is going towards principal, which brings down your principal balance. All right, so hopefully that helps answer those questions. So we've got another example here. And the way that I had the last class do it was try to create the table and tell me in the chat what's going to be in this cell after your third payment. I'm going to scroll back up now so you can look at the example. Okay, some of the answers are starting to come through. I got one that's on the money and one was close. And then I think, Isabella, yours is a question. Yeah, I'm looking for what's going to be the mortgage balance after the third payment. So you have the first, second, and third. Good job, Emma. Good job, Adam. Oh. A little bit low there, Elizabeth. All right, give you another minute and we'll go through it. A little bit low, Drew. No, I think you're taking too much off of it, but we'll walk through it now. All right, so the interest portion. This is a loan at 9% interest. So in order to calculate that here, that's 100,000 times 0.09, which equals 9,000. So in this case, your annual payments are stretched out over 20 years, and you can see that there's not very much of that going towards the principal. So we have now 10,955 minus the 9,000, and that equals 1955. That's going to be reducing the mortgage balance. So 100,000 minus 1955 is going to equal 98,000. No, excuse me. Yeah, 98,000. All right, I need to use a calculator. I have a brain cramp. $98,045. Just did not look right. Okay. And follow those steps through. And again, I'm going to embed an Excel file here so you can see how it works. Oh, got to go back and copy it. Give me 1 second. Trying to get it sized a little better here. All right, there we go. And so we see that the number that we were looking for was 93,591. So about 80% of you that typed in an answer had the correct answer. Did anybody else have any questions at this point? perhaps understand why they didn't get it correct? Formatting skills are not working so well. There we go. All right. So again, you can go in, you can open this up, and you can see the formulas in there, and you can see where the numbers come from. If you have any questions, just type in the chat. If not, we're gonna move on to the second part. Okay, so we wanna record the effect on the accounting equation for these transactions. And so initially you're gonna borrow money. So you have $100,000 in cash, and then $100,000 mortgage. And that's to borrow it. They don't show the actual purchase if there was a purchase here, but just talking about what you get and your liability. Then your first loan payment made would be $10,955 reducing cash. It would reduce the mortgage by $1,955, and $9,000 would go to interest expense. All right, I see I have a question in the chat. Can you scroll down so you can see part B? I'm not sure where I got to scroll down from. This is the, can you guys see that? That's part B. I'm trying to get as much of it on the screen as I can. Okay, so you guys are having a problem with it freezing up. Okay, so let me unshare it and then reshare it. How's that work? Okay, sorry about that. That was my error. All right, so again, the information up above is here. And then part A, and then part B says show the effect on the accounting equation. And then I hit the pause button, unfortunately, so you couldn't see that. So I apologize. And so the company borrowed $100,000 cash. So they got $100,000 cash. And then they had a liability of $100,000 mortgage. Doesn't affect our retained earnings. Then they make their first loan payment, which is this payment here, $10,955 in cash. $1,955 reduces the mortgage liability, and $9,000 of interest expense. Now we make the second loan payment, and it's still the same amount, $10,955 cash. And our mortgage is reduced by $2,131. And then interest expense is $8,824. Okay, and those came from the first two rows there. Got a question? Where's the $10,955 from? That's the payment amount. Okay. All right. Any other questions on part B? What I can do is I can color code the cells, I think. Okay, is that a little more helpful in seeing where that they come from? Okay. All right, now part C asks you to fill in the correct dollar amount that represents the financial statement where the item appeared. And so I'm going to leave this one kind of for you to practice. The answer will be on the exam. It's pretty straightforward in terms of what you're going to do here. Your income statement, 9,000. Your statement of cash flows, paid 9,000. Your balance sheet, it doesn't show it on the balance sheet for interest expense. Okay. So that answer will show up on Saturday. I don't want you to focus too much on getting the subsequent years. Focus on being able to get those first 2 years, because the types of questions that are going to be on the exam are closer to the multiple choice questions. Okay. So 13 is an example that you can practice for yourself, and then we're going to get into 14 through 18. And so bonds sold at a premium sell above 100%. Bonds sold at a discount sell below 100%. And remember that this is because the interest rate is lower than other companies' bonds at similar risk. Okay. Which they'll call market rate. So the information for 14 through 18, I'm gonna go ahead and insert a page break here. It says that the company issued $1,000 or $100,000 of 10-year 8% bonds at 98%. Now, these are the bonds that are going to pay interest yearly, but the principal is not going to be paid off until 10 years. So you're going to be paying interest only on this, and you're not going to be paying down any of the payment. So these bonds sold at a discount. The bond sold at 98 because the stated rate of interest was lower than the market rate. And it says how much cash did the company receive? So the bonds were sold at 98, which means 98%. So 98% times 100,000 face value equals 98,000. So the answer is D. All right, I've got a question. So the difference, somebody asked, what is the difference between stated interest rate and market rate? The stated rate is what's on the face of the bond, whereas the market rate is determined by investors. So let's think about what's going on in the world now. What have we seen the stock market do? Type in the chat for me and tell me what's happened to the stock market. Good. Okay. All right. Few people answered. Anybody else want to throw in? All right. We've seen the stock market decrease. And what's happening then is people are selling those assets. And when they're selling those assets, they have to take their money and put it somewhere else. So you can put it in a shoebox under your bed. You can put it in a bank. But right now, the interest rates are super low. You can take that money and invest in commodities. There's a lot of risk. So what people usually invest in the commodity is gold or precious metals because they feel like those are going to be safer. And so you'll see that the price of gold has gone up. But the other thing they do is they switch over to bonds because bonds, theoretically, if they have a good rating, are much safer. And so the market, because there's so much desire to buy them, the price and the interest that it returns also goes up and the interest returns down. So market rate is kind of determined by what people are willing to pay for it. And so the ultimate quote unquote zero risk market rate are the United States Treasury bonds. We've never defaulted in our 250 plus years of government. And so zero risk, the closest thing we have to it is our own bonds. And so our own bonds will pay about 3%. But people were so nervous about what was happening in the stock market that they were willing to pay more for those. So the effective interest rate was zero, and people were just happy not to lose any money. So on companies that have risk, the higher the risk, the higher the interest rate has to be. So it really depends on the company. But basically, you have to be given the market rate and the stated rate in order for you to determine what the relative difference is. Will they sell at par? Will they sell below par? And you just have to compare those two rates. Okay. So now it says, how much will bondholders receive in the first initial payment? And so with this case, they're paying interest only. Is due at 10 years. So interest is based on the face value. Here we had 8% bonds times 100,000 face value. So each year, bondholders will receive $8,000. And then how much cash will bondholders receive when the bonds mature? And then it says, assume that the final interest payment has already been made separately. So they are going to receive at the end of the term of the bonds, the bondholders will receive the face value plus any interest due. But here, the interest is already paid, so they receive face value of 100,000. Okay, so I'm going to throw the poll up again. If you have any questions, click yes. If not, click no. And then because Friday is Good Friday, I'll remind you again, we don't have class. The university is closed for the holiday. So have a good Friday for those of you that celebrate. And everybody else, enjoy your day and enjoy the weekend. If you have any questions for me, I'm here, but otherwise class is over. Yes, that's correct. So one of the questions was the bondholder bought something for 100,000 for 98,000, and then they receive 8% a year and get 100,000 back at the end, and that's correct. And so effectively, they're providing that company $100,000, but getting a higher market rate than the 8%, because they determine that company has a risk profile similar to other companies that are paying a higher interest rate. No, if I said there was an exam on Saturday, I apologize. We don't have an exam on Saturday. What I intended to say was that the classwork that is due on Pearson does not rely on this, but these answers to the questions, these practice questions, will be released on Saturday. So I'm sorry if that was confusing. Anybody else have any other questions? Not, have a great day, and I'll see you on Monday.